Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The semiconductor sector is facing what analysts are calling the AI chip shortage paradox, and it is forcing a complete repricing across NVIDIA, TSMC, AMD, and the entire AI supply chain. We are witnessing explosive demand colliding head-on with brutal production constraints, creating divergent stock performance and strategic inflection points that active traders need to understand right now. Here is the setup. The semiconductor market is projected to grow 26% in 2026, potentially hitting $975 billion, according to recent industry analysis. AMD projects the AI chip market alone could exceed $1 trillion by 2030. Demand is not the question. The question is, who can actually deliver the chips? And that is where the paradox lives. Start with TSMC. Taiwan Semiconductor Manufacturing Company just projected first quarter 2026 revenues between $34.6 billion and $35.8 billion. That represents a 25.5% year-over-year increase. Their advanced process margins are expected to improve from 62.3% in Q4 2020 to between 63 and 65% in Q1 2026. Strong pricing power despite capacity constraints. But here is the critical data point. TSMC is raising 2026 capital expenditures to approximately $54 billion. That is up from roughly $41 billion in 2025, a 32% increase. This is one of the largest single-year expansions in company history. TSMC CEO C.C. Wei stated the company has strong conviction in the multi-year AI megatrend during recent earnings discussions. They are building capacity as fast as physically possible. The problem is meaningful capacity expansion is measured in quarters, not weeks. Advanced semiconductor manufacturing does not scale overnight. Lead times for specialized equipment and facility construction create natural delays that no amount of capital can immediately overcome. Now look at NVIDIA. The H200 AI accelerators have generated orders running into the low millions of units for 2026 delivery. Unprecedented demand. But NVIDIA is completely dependent on TSMC's advanced manufacturing nodes, and substantial production increases are not expected until mid-2026 at the earliest. The company has requested increased H200 output from TSMC, but the foundry bottleneck is real and binding. Add regulatory complexity. U.S. export controls targeting China force NVIDIA to maintain separate China-specific products that comply with lower performance thresholds. This requires extensive redesign and qualification cycles, extending production timelines and adding layers of supply chain management complexity that further exacerbate global shortages. Here is where it gets interesting for traders. Despite NVIDIA's market leadership, the stock has shown only modest year-to-date growth through early March 2026. Meanwhile, TSMC is up 21.9%, Micron technology has surged 50%, and supermicrocomputer is up 10.8%. The market is recognizing that the AI boom benefits the entire semiconductor ecosystem, not just chip designers. This is portfolio rotation in real time. The bottlenecks extend beyond chip manufacturing. High bandwidth memory, or HBM, is critically constrained. These memory modules are essential for AI applications, but require complex manufacturing processes and specialized suppliers. Advanced packaging requirements like 2.5D and 3D integration technologies create multiple choke points throughout the supply chain. According to industry sources, the AI supply chain faces bottlenecks in wafer fabrication, start times, specialized equipment for advanced packaging, coordination across multiple component suppliers, and testing and qualification processes. These factors combine to create the lead times extending for months, even when commercial demand and pricing incentives are strong. Geopolitical tensions add another layer. Current U.S. export controls create ongoing friction in global semiconductor supply chains. Beyond direct restrictions on China, these policies require product redesigns for different markets, extended regulatory review processes, separate qualification cycles for different regions, and increased compliance costs. All of this limits operational flexibility and pressures margins. Let's talk margin compression, because this is the critical valuation question. Despite explosive AI demand driving capital expenditure growth and record order volumes, margin compression remains a significant concern. Supply constraints limit pricing flexibility. Capital requirements are increasing. Geopolitical compliance costs are rising. Inventory cycle management is becoming more complex. These factors may limit profit margin expansion even as revenues grow substantially. This is why the sector is repricing. The market is adjusting to the reality that supply-demand mechanics may not support the valuations that pure demand growth might suggest. Investors are distinguishing between companies that can navigate current constraints while positioning for long-term growth and those that face structural disadvantages. Industry experts indicate that meaningful relief from current supply constraints is unlikely before the second half of 2026. Even with aggressive capital expenditure programs underway at TSMC and across the sector, the timeline for bringing new advanced manufacturing capacity online extends into late 2026 and beyond. The strategic implications are massive. Companies are making decisions right now that will define competitive positioning for the next decade. Geographic diversification of manufacturing capacity, vertical integration strategies, alternative architecture development, customer concentration, risk management. These are the moves that separate future leaders from laggards. For traders, the opportunity is in understanding which companies have pricing power in this constrained environment. TSMC is demonstrating margin expansion despite capacity constraints. That is real pricing power. Micron's 50% surge reflects investor recognition that memory constraints create a separate bottleneck with its own supply-demand dynamics. Super microcomputers gains highlight the infrastructure build-out required to deploy AI at scale. NVIDIA remains the dominant chip designer, but the modest stock performance reflects market awareness that production constraints limit near-term upside. The company cannot deliver chips it cannot manufacture, and manufacturing capacity is the binding constraint through at least mid-2026. AMD benefits from similar AI tailwinds, but faces the same foundry constraints. The entire fabless chip designer model is constrained by TSMC's capacity. Intel's efforts to build competitive foundry capacity remain years away from threatening TSMC's advanced node leadership. The bond market angle here is the capital intensity. $54 billion in capex from TSMC alone represents enormous capital allocation that will flow through equipment, suppliers, construction firms, and the broader industrial economy. This is real economic activity with multiplier effects, supporting infrastructure-related equities and industrial metals demand. Crypto has limited direct exposure to semiconductor supply dynamics, but the AI compute build-out competes for power and data center resources with proof-of-work mining operations. As hyperscalers like Microsoft, Amazon, and Google secure power capacity for AI infrastructure, mining operations face rising costs and capacity constraints. Looking forward, the AI chip shortage paradox represents a transitional phase. Massive capital investments currently underway will eventually rebalance the market, but this process will take several years to fully materialize. The companies that successfully manage current constraints while positioning for future growth will emerge as leaders of the next phase of the AI revolution. The actionable insight for traders is that sector leadership is shifting. Pure AI chip designers face production constraints that limit near-term upside. Foundries with pricing, power, and memory suppliers with constrained capacity are demonstrating stronger relative performance. Infrastructure plays supporting AI deployment offer exposure without direct chip supply risk. As earnings cycles approach, expect continued portfolio rotation across technology megacaps. The market is distinguishing between companies with demand visibility and those with delivery capability. In a supply-constrained environment, delivery capability drives valuation. Monitor TSMC's capacity expansion progress closely. Any acceleration or delay in bringing new advanced nodes online will ripple across NVIDIA, AMD, and the entire fabless ecosystem. Watch high bandwidth memory pricing and availability as a leading indicator of AI infrastructure deployment pace. Track geopolitical developments around export controls, as regulatory changes could shift competitive dynamics rapidly. The AI chip shortage paradox is not resolving quickly. The second half of 2026 brings potential relief, but structural constraints will persist into 2027. Position accordingly. Favor companies with pricing power, diversified supply chains, and capital to invest through the cycle. Avoid pure demand stories without delivery capability. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.